All right, we got about 45 seconds until we get this thing going. Toboggan9 in the Twitch chat. What's up? Breaking the seal on the Twitch chat. Love to see it. 30 more seconds until we get this thing going. All right, let's get it going to the full screen webcam. Welcome back to another weekly live stream, live scan, analysis, whatever you want to call it. We're still working on the official name. I don't know if any of you guys are Netflix Love is Blind fans, but unfortunately, an hour ago they had a disaster with their live stream. But the good news for you, if you are right here, is we have a very reliable live stream every single week. So some would say that HT's got better technology than Netflix. I'm not going to tell you you're wrong. But the good news is we are here, we are live, and we are ready to get things going. I don't really have too much else to say. Fresh off the golf course, so still in the golf course attire, but definitely making sure that we were live on time for that 9 p.m. start. So let's just go to the standard presentation, move OBS out of here, and let's get things going. Where are we? Boom, there we go. Let me zoom in a couple clicks on this. The good news now is we've got this. If we get 30 viewers live, we are going to give away one of these Yeti HT tumblers. Let's go back to the live. There we go. It's not focused for whatever reason, but we're giving away one of these HT Yeti tumblers. Still not focusing, whatever. But you know what they look like. So if we get to 30 live viewers and on the standard presentation, we've now got that in the bottom right over there. So we will know what our progress is looking like. So if we get to the number, we're doing it. We are 18 away as it stands. If we get there, I would be thrilled. But we'll keep an eye on that. If we hit it, let me know. I may not see it, but let's get into it. We're starting off with recapping last week. Last week we made a total of $174. Don't spend it all in one place, right? Definitely a little bit less than we're used to, but there's a little bit of a silver lining in this. We slightly underperformed the S&P 500. We slightly underperformed NASDAQ. The way I view it, that's not too big of a deal in my opinion. What I think is more important to note about the trend last week and how our result turned out is the fact that pretty much everything we were holding except for two positions moved against us. And yet, despite that fact pattern, we were still able to take home a profit. So anytime objectively, ignoring how the market did last week, if we could be in a position where most of what we're holding is moving against us, yet we still come away with a profit, that's a very, very good place for us to be. Affirm and Unity were really the only two that kind of moved in our favor, I believe. Actually, Unity dropped as well. I think Affirm and maybe Laser moved in our favor. But DPST moved against us. We still made money thanks to the premium we were selling. DWAC, look, moved against us, dropped 22 cents. Still made money thanks to the premium. ASTS, that's probably our one big regret of the week, and we'll circle back to that one in a second. Peloton definitely moved against us. You could see down here we re-entered, and that was a good thing that we did do that because it would have gone a lot worse. I think we played that one pretty well, and we could recap that one shortly. UVXY, SPXU both moved against us, and still net basis between those two trades, we only lost 25 bucks. Petty Bourgeois, welcome to the chat, welcome to the stream. What's going on? So, maybe some of the more significant ones that might be interesting to talk about. Last week, the big thing, of course, was that we had a CPI number come out. I believe it was Wednesday morning, and then Wednesday afternoon, we had a FOMC from the Fed, which we both know from our experience so far with these interest rate driven events are events that can make the market a little bit volatile. And with that volatility, sometimes it's best to just take the hands off the wheel and step away for a second. So that's what we did on a couple of these positions like Affirm and Peloton. We closed out for a profit combined of 300 bucks. And I'll tell you, when we have volatile events like that, there's nothing. Yes, we could have the volatile event move in our favor and we make a little money, but the way that we set these trades up with the positions that we're taking on, there's much more downside if something moves against us than upside if something moves in our favor. So what we want to do, and again, we still do have that cushion if things move against us. That's why we do what we do and why we willingly put ourselves in that situation. But with that said, when we have a volatile event like we had last Wednesday morning with CPI, what we want to do is try to take a little risk off the board. And we did that with Peloton. Let's walk through that one and talk about why, even though we lost money on Peloton last week, I think we did a very good job managing it. So if I type in PTON right here, we go to maybe the 10-day chart. We'll see, let's do 5-day here. We'll just get the whole week in Monday, Tuesday, Wednesday, Thursday, Friday. Boom, we've got it all there. So we started with Peloton on the 11 strike puts. We sold these for 33 cents. And on Tuesday, it was about to close at about 11.50 a piece. Remember that strike at 11 was hanging out down here. So we said, hey, we know that there's going to be a volatile event on Wednesday morning. I think it's probably best if we close this position out and take profit. Because closing out for 14 cents is a little over half of max profit, which is good because you're only 2 out of 5 days through the week. So in theory, you're 40% of the way through the week. You take over 50% of max profit. You're outpacing that linear progression of taking profit, which is a place that we like to be. And further, you get to avoid that volatile event Wednesday morning. So we locked in $95 of profit. And then, of course, Wednesday morning, the volatile event occurred. Peloton dropped from 11.64 down to about 10.60 by about 10 a.m. on Wednesday morning. So from that position, we said, hey, it was smart that we took profit, because if we didn't, these would be worth about, at least 40, 50 cents a piece. We'd be looking at going from a gain, even though it wasn't a massive gain or anything, we'd be looking at going from a gain to a loss, which is a position that we never really want to be in, and that's why we want to take profit early. And since we did take that profit early, we were able to get back in. So we reinitiated a position with a lower strike and more premium than we closed it for, right? The initial position we closed for 14 cents a premium. We could maybe zoom in another click. We closed the initial position for 14 cents a premium. And again, this was an 11 strike. We opened a new position at a lower strike, 10.5, for more premium, 26 compared to the 14. So we're doing better on both fronts. Lower strike, more premium. To me, that was a no-brainer to go back in. And we'll remember that, starting with 5 contracts, that's a half-size position. So we have the flexibility to double up. And that's, as you can see right here, a little bit of a spoiler alert, but we did have to end up doubling up on Peloton. But the way that worked, again, was that 10.5 strike goes for 26 cents. We know that 10.24 is going to be our break-even price on the new position. So 10.24 is right about here on the chart. And what we'll also want to keep in mind is when we started this position this week, again, it was that higher 11 strike for 33 cents a premium, so it was a 10.67 break-even price, which was all the way up here. So not only do we now have a lower break-even price, but we've already also locked in profit off that initial position. So moving forward, we could see here that on Wednesday, it got around there. But when that happens, we don't necessarily want to double down right away, because right when it gets down to this break-even line, there are 2 things that could happen. The first is it kind of hangs out around the break-even, maybe bounces back up. We don't have to touch anything and we don't lose any money. So long as it finishes at or above this red line, we're good to go. But scenario 2 is that it continues down further below this red line, which is what we saw a little bit into the back end of Thursday and on Friday morning, which is not ideal. And again, we've got 17 viewers right now. If we're looking in the bottom right, 13 more, and we are giving away one of these Yeti cups. So back to what I was talking about. We know that 10.24 is our break-even price. And since we started with the half-size position, I can't emphasize enough, having cash in your back pocket is giving yourself flexibility, and giving yourself flexibility is exactly what you want to combat a volatile market. So we were able to double down with a 10 strike put. And since we started with 5 contracts, added 5 more contracts, that's a cent for cent reduction of our cost basis. So if I pull up the old system calculator here, we're going to see that 10.5, our initial strike, minus 0.26, our initial credit, gave us a 10.24 break-even price. And then adding that 10 strike put for 21 cents took another 21 cents off. So we're now sitting here at a 10.03 break-even price. On a stock that Tuesday afternoon was at like 11.55. So a really nice value from that perspective. But our new break-even price was down here at 10.03. And of course, on Friday, things aren't always going to go your way. That's just one of the things that happens in the market. If every trade went our way, I probably wouldn't be streaming live every Sunday. I'd be living on an island playing golf every day. But you know what? We're here. Let's keep talking. So on Friday, when we went all the way down like that, it sucked. We took a little bit of a loss. All in all, it ended up as a $345 loss. Now, if you count that first $95 of profit, it was a $250 loss, which in my mind isn't too bad for a position where it started the week and almost touched $12 a share and then finished 3 days later at 9.50. That's a roughly 25, 30-ish% dip on a stock in 3 days. And all we have to show for it is a $250 loss. And the great part about this, we just roll these into the following week, right? We know that our break-even price was 10.03. We roll these into the following week. So what we have right now is a 10 strike put for 55 cents and a 9.5 strike put for 29 cents. And what that is, remember, 345. And if you want it, let's include, if you want to include the 95, you can, you can't. It is what it is. But a 250 loss on Peloton last week. And at Peloton's current price as it currently stands, which is 958, still a far cry from the 1150 level we were initially playing this at. Oops, I did hit a button on accident. We're going to make back at this level $210. So, all in all, with that little bit of a loss, the initial gain we locked in, with Peloton at 958, the price that it closed out on Friday, despite the fact that in just 5 short days we had this severe of a loss, a 25, 30-ish% drop on, it's not 30, it's 20, 25, excuse me, getting late. But even then, that severe of a drop within 5 days, the fact that we can not just absorb it, but also be in a position where maybe if it just bounces back up to like 975-ish, all of a sudden, we're making 295 this upcoming week, and we're back profitable on Peloton just at 975 here. Our new break-even price is 967-ish. So we started here. We moved it down here with the flexibility afforded to ourselves by doubling down. And then by rolling things into the following week, we're now down here on a stock that started all the way up here. And in the grand scheme of things, could it go further down? Absolutely, right? It looks like there's a little bit of support down at this 9 level. We could keep going down. But the idea is we keep playing this week after week after week and keep moving these red lines down, down, down. If we could do this much damage, right, to our break-even price in 3-4 days' time, if we keep having to ride this thing out for a month, there's no reason we can't get back down to that $9 price level. And again, it could also bounce all the way back up to 10. You never know what could happen, and all of a sudden we're pulling $420 in the following week. So that's where we stand with Peloton. That was probably the trade that moved against us the most severely last week. The only other one I would talk about is ASTS. And this is, what I would say my big regret on the week. So if we go to the 5-day chart, what we'll really notice here is Tuesday afternoon, it was trading at, 450-ish. Our strike was 450. The big issue here is I think we had an opportunity at one point to take profit, closing that 4.5 strike put for either 15 or 20 cents. That would have locked in between $150 and $200 of profit. However, Wednesday, Thursday, Friday, despite the fact that the market was relatively stable, this is just what happens sometimes when you've got a diversified portfolio between individual stocks. Some of those individual stocks are going to take a little bit of a dive on you. And it fell all the way back down to 387 by close on Friday. And this is one where we talk about, do we want to roll it into the following week? Do we want to run through the process that we talked about with Peloton and just keep things moving? Or do we want to just cut it loose? We had been running with ASTS for a couple weeks. Last week we lost $300 on it. The week before we made 40, and I think that was the extent of it, right? So we were down 260. All we had to do was really make back 26 cents on the stock. So our break-even price was in, the low 4-ish range, which isn't, inattainable. However, to me, when we look at what we could have rolled to, and we look at this upcoming expiry, the April 21st expiry right at 4, 10 and 15 cents of premium just is not that much to me. That would have driven our break-even price right around 395 to 4-ish. But previously, week over week over week, we've been able to sell 20, 25-ish cents of extrinsic value, and we're looking at a full 10 cents lower than that. So this is a great example. Every now and then, we'll be of the opinion that, hey, I get the question, hey, this is a position that I've had for a couple weeks. Should I continue to roll this? And this is an important point. We'll go back to full screen. I'll get the question where people say, hey, I have this position. Should I roll this into the following week? The single best way for you to evaluate if you should roll a position into the following week is for you to look at the position and say, hey, if my portfolio were completely empty, all I had was cash, is this a position that I would open in my portfolio? If the answer is yes, absolutely keep it running. But if the answer is no, as was the answer for us for ASTS, it's okay to just take a small loss and keep the line moving. The worst thing in the world is if you get a little bit too stubborn chasing some of these down that you're not fully committed on. And losing money on a stock that you're not in love with is one of the worst feelings in the world, because in the back of your mind, you're like, okay, I knew that this stock wasn't going to do great, yet it's still kind of digging into my account balance. You know, there's so many different options, so many different potential trades out there that if there's not something you're really in love with, don't need to take the trade on, because as we'll probably see a little bit later if we go to our option scans, there's a lot out there to find and fall in love with. If you don't love the trade you are in, just get out of it. It's okay if you have to call it a $200, $300 loss, but the last thing we want is you digging your heels in, getting a little bit aggressive and a little bit stubborn and losing, $900, $1,000 on something that you never really were that bought in the first place. So back to the standard presentation. That was my little spiel. We've got 16 viewers. We're 14 away from the giveaway. Will we hit it? We'll see. But back up here. And that was, I say that's the regret because we had the opportunity to close that out for a profit. That would have been a roughly $500 swing in our account. It would have taken us a little bit more profitable. But at the end of the day, you're going to make mistakes throughout the year, and really every single week you're probably going to make small mistakes. Everything is so much easier to evaluate in hindsight, but the best thing you could do is run through the exercise that we are running through right now and say, hey, this is what's been going on. Looking back, we could have done this better, we could have done this better. And really the only thing that I think we could have done better was the way that we handled this, and potentially either cut the position in half, because sometimes I'm like, I don't know if I want to keep this position. I don't know if I want to roll this position. If you've got 10 contracts, a really good way to compromise with those conflicting thoughts is just to close 5 of them. That way you get the benefit of taking profit on half. And if that little devil on your shoulder telling you to take the position into the correct, then you get to make the money. Faux Life, appreciate the follow. Glad you've made it into the stream. And I'm sure you've probably got tons of questions. And if you've got any that you'd like me to cover live, feel free to throw them in the chat and I'll be happy to address them. So that was really the one regret. DWAC, we're continuing to just quote unquote play the game here. We got 19 viewers. We're at 19 viewers. If we get 12 or 11 more, we are there. We're there and we're giving away the mug. But really not a ton that I'm too worried about. We could maybe talk about the process of this DWAC trade really quickly. And again, for those of you that haven't heard much about this trade, DWAC is a SPAC right now. Big picture on the SPAC is that it's not going to go really below $10 a share before the merger. The way that a SPAC works, SPAC, Special Purpose Acquisition Company, is it effectively is a blank check company, meaning it's a holding company, has a bunch of cash. They find a private company that says, hey, I want to go public. The SPAC, this pile of cash, is a publicly traded entity. So they take their cash, they purchase the private entity, undergo a reverse merger, and in that process, the private entity becomes public, and it's a little bit of a loophole around the traditional IPO process. So all that to say, right now, the stack of cash that's sitting in DWAC is worth $10 a share, as you could see from back here. Now, we've run through this exercise tons of times. These are some extreme examples, but you could have a SPAC that's worth 10 a share, and once they merge, that $10 price floor is gone. Before the merger, it's there, and it's not going to go below 10 because cash is cash. It's not going to be worth less than cash. That doesn't really fluctuate significantly, that is. But after the merger, all bets are off. This thing's trading at 35 cents after it already had that $10 price floor. But big picture here, it's got the $10 price floor. There hasn't been a merger, and there's decent out of the money options. So, and the other thing that gives us confidence that it's not going to have the merger for a while, again, we look at those June 10 strike puts. Those things are worth 3/4 cents a piece. If there were any risk whatsoever that this thing would be below 10 come June, these would be worth more than 3 cents. And if you're worried about that risk, just buy these for 3 cents. It'll protect the hell out of your position and you'll be good to go. So with DWAC, our idea here is with the volatility that we've seen on this over the past few years, and even just the past 180 days, right? It's susceptible to these big green candles. Because of that, there's always going to be some call premium on the upside. So the idea is we're purchasing shares, continuing to sell calls, and trying to drive our cost basis down to 10 as quickly as possible. And then from there, we could get a little bit more aggressive and try to play a little bit more upside. But the idea here is if we get our cost basis on DWAC down to 10 in the next couple months, we've essentially put ourselves in a position that we can't lose. So we're trying to walk it down, 30, 40 cents a week. And it may be one that we have to be a little patient on, but here is our progress so far.
So we started 2 weeks ago with DWAC. We bought the shares for 14.31. That timing could have been way better. This is a half-size position at the moment, though. So if we really want to, we can double down and more severely drop the break-even price. But I want to save that double down just in case there's a really bad week. As it currently stands, the amount of call premium that's available on the market from these options is plenty to get us where we want to be by May, by June, by that quote unquote deadline where we might start to see a little bit of a merger. So 14.31 is the price that we bought those shares at. 14.5 strike calls are what we sold for 49 cents. So after week one, our break even was 13.82. And then what we did was we sold some 13.5 strike calls for 46 cents. So after week two, our break even was 13.36. And now this upcoming week, we took a little bit more of the top, a little more upside off by rolling down to 13 strike calls. But again, we got 41 cents of premium. So our break-even price is about $12.95 as it currently stands. But big picture, in just 3 short weeks, we've lowered our break-even price by $1.20. If we're able to continually get that kind of premium on these things, we're going to have this break-even price at 10 in no time. And if we really, really wanted to get aggressive here at 13.12, the other thing we could do is look at selling 13 strike calls for about 30 cents a piece. And that would take our break-even price down 30 more cents to 12.65. So then we'd be situated somewhere in this area right here, which again, it can get below there, right? There's downside to 10. So ideally, what I really, really want to do is hold off on that double down until we get down to a level where there's a big red candle in a week and it's like, oh shit, we've got to catch up. Because once you use that double down, you lose a lot of flexibility on the trade. It's not to say that the trade can't be saved, but again, always better to be safe rather than sorry and just keep that flexibility, aka keep that cash in your back pocket. So with that said, that's our stance on DWAC. That's the trade we have going for the upcoming week. But all in, that's what happened last week. Profit of 174. Did we underperform? Yes. In the context of what we had, though, I think that's okay because we had a lot of stuff move against us and still made a profit. As long as we can keep taking baby steps forward, no matter how small they are, right? Even if it's a 0.09% gain in a week, as long as we can avoid the red weeks and just keep compounding green weeks together, I think we're going to put ourselves in a really nice position. As we've talked about, we're barely past Q1. We're looking at a 9% return on the year. The S&P 500, NASDAQ, they're going to cool off. They're going to flatten out. They're going to have these spikes up, these spikes down. The idea here is not to get too impatient on the spikes up and try to chase and chase and chase and load up our portfolio and get crushed when it falls back down, but rather stay patient. If we have to make $700 a week, if we have to make $200 a week, we'll wait as long as we need to wait for some volatility to be pumped back into the market, for another big red week to show up, and let us scale into some of these trades. Because the worst thing that we can do here at this point, and the market's very good at letting people fall into this trap, is getting impatient with these gains that we've had. And not including what we have projected for next week. Over the last 5 weeks, we've still averaged over $1,000 a week, which has been good progress, right? As long as this line's moving up, we're good. The big thing we want to avoid are these big red weeks. And outside of 1 week this year, we've been really, really solid in that regard. So we want to stay patient and not undo the work that we've done up to this point. Because look, if you make $600 a week for 3 weeks, that's just as good as you making 3,000 and losing 12 and losing 1,200. Yeah. So we don't want to lose sight of that, right? We definitely don't want to lose sight of that kind of math. Just because we're not shooting up with the market. Again, the reason we're not doing that is because when the market falls back down, as we've seen here in this stretch, we're not going to fall back down with it. We're positioned patiently, and we are positioned well for a reversal in the market, because just when you think a dip won't happen, it will. And even with this more patient positioning, quote unquote, we're still outperforming the last 3 months. So I'm more than happy with where we currently stand. We've got a couple more weeks to go in April. Let's finish that month strong and keep going from there. We may not knock it out of the park like January, but that again was a month where the market returned almost 8%. So the idea here is we want our strategy to be successful independent of what the market does. And I think we've accomplished that. So talking about what we've got lined up for next week, the week of April 16th, we're in a decent spot, right? Ideally, we want our base return, quote unquote, to be about 1%. But with what's going on out there and talking a little bit more on a macro level, looking at VIX, VIX is as low, and this is the volatility index for those of you who are unfamiliar. This thing is as low as it's been in like the last 6 months. And when this thing gets low and you go into your scanner and you see that a lot of these VIX instruments are oversold, right? 32 on VIX. UVXY is a leveraged volatility instrument, 33. VXX is another volatility instrument, 33. Whenever volatility starts to get oversold, be very, very careful because it could pop back up very, very quickly, right? Even just looking at VXX as an example over the last 180 days, every time this thing gets oversold a little bit, the last instance was beginning of March, boom, pops right back up. And you look at the S&P 500 beginning of March, what happened? The answer is you had this pretty big slide from 406 down to 382. So that's what we want to be wary of. The market's really, really leveling out here. It's at a 62 RSI, so slightly overbought, and we're probably running into an area at this 420 level where I imagine we start to see a little bit of resistance. So I want to, my goal from tonight is we've got a lot of bullish trades heading into next week. I'd love to identify some bearish trades as well. So that's going to be the goal with our scanners. But let's talk a little bit about some of the bullish trades that we have on the board that are, combining to give us this projected 0.78% return. And again, how does this return work? This is just calculating what these current positions would return for us if nothing moved in the market. Because things can go up, they can move in our favor. This number could go a little higher, but they could also move against us. They can go down. We find that on a week-to-week basis, one of the more accurate, more objective ways to project what we might make is just to say, hey, what would this make if nothing moved at all? And of course, that is going to be a little bit biased to the upside when you're selling options, because if nothing moves on a given week, you're collecting all that extrinsic value. But that's why we do what we do, because that is a reality of what happens if nothing happens in the market. So top to bottom here, Affirm, we started this one last week. We got out for profit before CPI on Wednesday, which was a smart move in my opinion. Would this have hit max profit and given us a little bit more cash? Yes, because it closed above 1050. It closed at 1104. But just because something would have made us more money doesn't mean that it's a smarter trade. That's another thing that I definitely don't want to conflate losing money with a stupid trade. And it's equally important not to conflate making money with a smart trade. So we did the right thing here. We took our $205 profit. We moved on. The next week, boom, we're going right back in. We had 10.5 strike. We've got 10.5 strike again, 37 cents a premium. We're going to go right back in and get that cash that we potentially left on the table last week. But that thing finished up at 11.04 last week, so we've got a decent cushion built out. It's going to have to drop 8.98% Affirm for us to lose a single dollar on the trade this week. Peloton, this is one we rolled from last week. At this point, RSI is probably getting pretty oversold because it has moved aggressively and consistently against us recently. Still at 36.74, so there's definitely a little bit of room to the downside here. We've got that 9 level picked out. I think that's where I want to start to get a little bit more aggressive if we do see it. But long story short, on a weekly basis, 935, around that level is going to be our break even on Peloton. So we're going to keep that one going. And again, these 10 strike puts, these are in the money. So we've got upside at 10 a share. If this pops back up to 10, all of a sudden we've made $420 on the position. If Peloton doesn't move a single cent next week, we've made 210. So we're starting ourselves in a position that's advantageous. If we get a move in our favor, which the idea with this strategy is, if you have something with these big red candles, at least on a short-term basis, it'll run into support. It'll get back up where you want it to be. And even if something's falling all the way down sharply, there's still some green candles on the way down, as we've seen evidenced over the past year on this one. So that's the idea that we try to play with the strategy, just in general. American Airlines, this is one we started last week, and we got out for the exact amount that we started it at, right? So what we did here, we had a 13 strike put. We sold it for 21 cents. Our initial break even was going to be $12.79. Now we bought this 13 strike put for 21 cents. We sold the new one for 38 cents. That's 17 cents more than we closed it for, meaning a 17-cent credit on the roll, meaning a direct reduction of our break-even price of 17 cents. So we head into next week with a break-even price on American Airlines of $12.62, which is, in my opinion, a very, very nice place to be, especially since we're still in a half-size position. We're more than free if it continues to drop down to like 12.5. We could very, very easily scale in with some 12.5 strike puts, and we would be good to go. There we go. Faux Life, take an assignment of AAL, $12.75 a share, not too far away from where we're at. So moving further down, UVXY and XPXU, these are our hedges for the week. UVXY, of course, is volatility. We talked a little bit about that a second ago when we had the VIX chart up, the VXX, the UVXY chart up. The idea there is volatility is getting oversold. It's being sucked out of the market. If the market pulls back and moves against all of these bullish positions we have right here, in theory, volatility should shoot up and we should make some cash on this one. We're really only shooting for about 140 bucks. Again, this isn't a massive hedge. The last thing that we would want is for volatility to continue to get sucked out of the market and this position our hedge to like really pull back and drag against our overall profit. So I think we're sized appropriately there. SPXU, we've been following this bearish trade for a little bit, and despite the fact that we've had a flat week and then a green week, I think we're still in a decent spot on that. One good way to look at this is we started SPXU 14.5 strike puts like 3 or so weeks ago. So 14.5 minus 0.26. Our break even was 14.24. The next week, we sold some 13.5 strike puts for 37 cents. We closed them out for 8 cents. That's a 29-cent net credit, which lowers our break-even price. And then we also sold these 13.5 strike puts for 23 that we bought back for 1, so that's 22 more cents. And now you roll over to the next week, which is last week, and we had SPXU where we sold the 13.5 strike calls for 40 cents, meaning at the end of last week, our break-even price was 13.33 on SPXU, and now into this week, 13.3 is where it's at. 13.33 is our break-even price. We sold the 13.5 strike calls for 23 cents. So overall on SPXU, despite the fact that this benefits if the market goes down and the market has moved up largely over the last 3 weeks, we've got a break-even of 13.1 and we still have a half-size position on SPXU. So in position to overall make money on that position over the last 3 weeks, and we saw the flexibility to potentially add more as need be. So that is why, I mean, a great example there of why we do what we do. Even though the market has moved completely against a way that would benefit this trade, we're still on top because our break-even price is lower than the current price of the stock, and we've done it without much management whatsoever. So great example of us running the HT wheel, throwing a coverage strangle in there, continuing to roll the covered calls, just being patient week over week. Even if it takes 3 weeks for us to make 20 bucks on a trade that's moved against us, the fact that we could end trades that have moved against us profitable in that short of a time frame is going to be very, very successful for us in the long run. Because of course there are trades that we don't really talk about that much every week, right? Affirm went great for us. DPST, perfect. DWAC made us some cash. Unity was fantastic. Delta Airlines, money. Laser, 140, right? We've got like $1,000 worth of trades here that went great without having to really manage. It's the losers that are really going to determine your long-term success in the market. How do you manage those? How do you handle them week to week? How are you getting too aggressive in your trades? And I think this approach that we've talked about, with that SPXU example being a great example of it, is one way that we try to manage those position sizes and make sure that our losers aren't killing us. In fact, if we could turn losers into winners, even if it's just 5, 10, 15 bucks, that's a great place for us to be. We've moved back into Unity. This is one we've been playing this thing like every single week. And even though it's gone up, gone down while we've been holding it, this thing offers so much premium that it's such a manageable position. We closed a couple of contracts. We cut it down to 3 last week, which is why instead of hitting max profit, we've got a little bit of a debit to close here. And then we only rolled those 3 into next week. Reason being is 159 is decent, right? If we wanted to start over with 5, it takes us up to 265, right? So it's only like, $106 more to take those 2 contracts on. But at the end of the day, I don't think that additional position size is going to be worth the risk. So happy to just start with 3, back of my mind. Don't need to worry too much about our position sizing there. Because when you start selling these 28 strikes, the position size gets up there a little bit. Even with only 3 contracts, that's 4.32% of our total account. So definitely be mindful of that position sizing there. DWAC, we talked about this one. Anywhere 13 and above, this is going to fetch us 155 bucks on the week. So we've got a decent cushion there. Laser, we're getting right back in that. Last week we entered in the 5.5 strike puts because we really like the way that implied volatility, support, and we saw a very, very large put sale at like the 5 and 5.5 levels last week, which is a very, very bullish indicator in my opinion. So we entered into that last week. It got us 140 bucks. This week, the idea is we're going right back in for the same exact premium. So, one thing, this came up on our scan, and if it just holds 5.5 again, 30 seconds of work on the scanner is going to make us 280 bucks. That's a pretty good hourly rate. And if you've got a better hourly rate than 280 bucks in 30 seconds, why are you watching this stream? Go do whatever is making you that money. And then rounding it out with ChargePoint, this is one that was kind of on the radar. It's not a massive one, right? You know, you're only pulling $95 in max profit, but the idea is I wanted to get up and around 15-ish, 1500 that is, at base profit for the upcoming week. So I threw it on there. It took us up to 30.88% fully cash secured. And of course, anywhere below like 35, 40 is kind of foot off the gas mode. And we've been there for the last several weeks. And despite the fact that we've had that approach of having the foot off the gas, you know, if things hold the way they are, there's still $4,000 of profit over the last 4 weeks with very, very minimal risk is the thing that I cannot emphasize enough. You know, it can be frustrating when the market's moving up and you're like, oh, you know, it's running away and we're not making as much as the market. You're going to be very, very thankful about that, or thankful for that rather, when the market does decide to dip. When we have stretches like this, when the S&P 500 ETF SPY looks like this on a 20-day basis, and there aren't really any dips, you're going to be probably get a little bit impatient, but I can guarantee you, just take a look at that 1-year chart. The next dip is not far away, so we want to be sure that we're prepared for it. Because again, the last thing we want to do with this strategy is put ourselves in a position where we lose $2,000 in a week, and all of a sudden, you know, we're scrambling for the next week or two to try to get back and make that back. Even if it's a tiny amount like 174, and again, that was far and away our smallest winning week of the year. Oh, I take that away. We had a 116 week. But even if it's just a small week like that, a step in the right direction, you know, as long as we're going in that direction, I'm perfectly happy with that. So that is my opinion on next week. This is what we currently have for next week. We noticed that a lot of this is bullish. We've got UVXY and SPXU, which are bearish, and these make up about 5% of that 30%. But looking again at this more macro level trend with the S&P 500 ETF SPY, it's at 62.04, which is overbought. Very, very rarely on a 1-year basis will SPY get above 70. It's happened once in the last calendar year, and it was last August. And right before it went from 433 at the top to about 350 at the bottom, a massive, massive 2-month dive. But this is about the area it starts to fall back down. So we can identify some, you know, initial resistance, right? This is the top of the candle from last week at the peak. We see that it's running into resistance from the back end of January, early February this year. If we extend this line out to the left, if I can hit it when I try to click it, boom, this lines up pretty nicely with some hard resistance back in May and June of last year. And again, right after it hit that resistance, dropped off from 415 down to 363. Now, a lot of that was kind of CPI interest rate driven. But the point here is it doesn't necessarily need to be a massive dip. Any dip at all could hurt you if you're overly bullish on the market. So just to be mindful of what else is potentially out there, let's just run the oversold alert. Folef's got a question about FRC. He was selling 12 strikes last week. With FRC, I'm not a huge fan of it. And the reason being is because any of these regional banks, just like with Silicon Valley Bank, could really go under at any given point in time. So if we go to SVBQ, we go to SIVB, boom, it stopped trading at 106 after going from 300 to 106. We throw a Q on the end of that to get the bankrupt SIVB, and it's down to 57 cents. And that's in the blink of an eye, right? Option selling helps us a lot when there's premium, but there are some drops that are so quick, so severe that we just simply cannot be helped from option selling. And this is a good example of that, FRC. So if you want to get some exposure to those regional banks, because right now they absolutely do have a lot of premium. This is a lot of premium. 7% right at the money is a lot of premium because it means like 30% out of the money, you could still get that 1 to 2% premium. That's a lot. But you run the risk of this individual bank, you could just get unlucky. And there are a lot of unlucky broke people in the market. Let's not have an unlucky outcome, you know, be the reason that we force ourselves in a position saying that, oh, you know, it's not likely that this would happen. You know, that'd be pretty bad luck. Pretty bad luck can happen at any time, you know, and we want to put ourselves in a position where bad luck can maybe ding us, but not completely take us out of the game here. So if you want exposure to these smaller banks, what I've been doing is DPST. This is a regional bull ETF, and it's a culmination of all of these. So if there's one individual bank like FRC, boom, and you're taking the words out of my mouth, Faux Life. You know, you're with it right now. We're on the same wavelength. But DPST, you get exposure to all these different regional banks. So you get the benefit of the premium without the individual bank risk. Now, don't get me wrong, if one of those banks fails, DPST probably will take a little bit of a dive, but it'll be nowhere near the dive that that individual bank will be taking. There's still plenty of premium here, right? You can get 5.26% just out of the money, which is a really nice place to be, in my opinion. You could, really go down to 6 and get 3%. That's nice. I'm up at 7 because we've been rolling this position, and if we want to talk about the lifetime of this DPST position we've been in, this is one that's been managed very, very nicely as well. We started DPST, I believe, when it was like $8 a share the week of 4.2, which was not too long ago. It was less than 2 weeks ago that I believe we started this trade on DPST. So if again, I think we've got like 900 of these calculator windows up. We started with the 7.5 strike put. We sold it for 30 cents. Boom, break even was 7.2. We averaged in with the 6.5 strike put for 21 cents. That expired worthless. So we roll into the next week with a 6.99 break even price on DPST. From there, we closed for 58 cents. We opened the new one for 53, which is a debit, so we add 5 cents. However, we lowered the strike. DPST went from 7.5 to 7 by 50 cents. So that lowers the break-even price as well. So we went into last week with a 6.54 break-even price. We closed it for 22, and then we opened the new one for 60. So that's, I believe, 60 minus 22 is like 38 cents. So we lowered our break-even price another 38 cents. That's not 38, that's 3.8. So our new break-even price is 6.16 overall on DPST, meaning that if it goes back up to 7 and we hit max profit, that's an 84-cent gain. 84 on 500 shares because we have 5 contracts. It's going to be a $420 gain if it goes back up to 7 a share. So let me see if I actually did the math on that correctly. So DPST, we'd make 300 this week. DPST, we made 155 last week. And a couple weeks ago, we only lost 100-ish. Boom, $420 of profit if DPST goes back up to $7 a share. So again, fantastic place to be in for us. I don't think I did the math in my head quite right, some of the pitfalls of live addition and subtraction. But point being, we've got the calculation right here. We make $420 over on DPST if it just gets back up to 7 a share. And of course, we've got this really nice break even just this week alone, excuse me, of 6.4. So long as it doesn't drop 7.19%, we're going to be making some cash on that. And that is my approach to these regional banks, which could sometimes cause a little bit of issue. Expose yourself to that ETF so you don't have that single bank risk. And this is what we've got, right? We can go back to the scanner here, which I was about to do before I went on a little bit of a tangent. Go to personal. We're going to go to HT oversold. This is going to give us some bullish opportunities. We're going to see a lot of stocks that were already in here. DPST, we're already in that one. It's oversold. The idea is you pull up this chart, you go to the 1 year. We're on the 1 year. Boom. And you've got an RSI that's down in the blue. When you've got that RSI down in the blue, that's when we want to enter. But we also have a lot of other stocks up here. Wish, this is on here incorrectly. And the reason being is because you're going to have actually, I take that back. This might actually be correct. Yeah, previously it wasn't adjusted for the split and it was coming up on the overbought scanner for whatever reason. However, this one is correct. It's finally down to 29. It's below 30, which is that blue level we like to talk about. It's a little bit oversold, decent bullish entry. However, we just had this reverse stock split to pump the price of the stock up. It was trading for like 35, 40-ish cents, I believe, before. Boom. Yeah, you nailed it, right? They did reverse split 1 to 30 a couple days ago. So I really want to be wary of that. I love the premium on it, to be honest with you. Looking for the coming week, you could get 2% down at 6.5, which is just massive, massive cushion down here. Which, I mean, in the scheme of things, this is when the reverse split was announced. It gapped down a lot based off that and then sold off after that. It's one of those things we talk about, the continuation of bad news, which I think that kind of was. Anytime a company has to scramble and make a move like a reverse split just to get their stock price above $1 a share so they don't get delisted, of course, that's not the most bullish news in the world. One that comes to mind that did something similar is going to be Mind Medicine. They actually were going off and I guess went back down. But if we go back to the past year, boom, there you go. You've got a 1 to 15 split. And what we saw here was you have this split And then the stock sold off a bunch. You know, it started at 11, 12-ish a share after this split. And then, you know, 1, 2, 3, 4, 5 days later, really started selling off. I mean, this thing's down to 316 a piece. So I don't want to fall into this fallacy of thinking that just because there's a reverse split and there's a big initial dip, I feel like this right here is what we've seen so far on Wish. When in reality, you look at something like MindMed, and this thing has really continued to sell off. So I don't want to get too comfortable selling, you know, puts up here when if this follows a similar pattern, right? It's right around that 11-ish, 12-ish, 13-ish dollar level that we just looked at. If this still has 50% down to go, you know, I don't really know. Now, one thing to note is that this move on MindMed happened, look, this is last September. So this has been a roughly 7-ish month move. And if we look at Wish, it's already down to 757. If we sell a 6.5 strike put for 15 cents, we're already down at 635. I don't think that's fast enough, and I'm not really in love with the stock. We could check the news feed to see if there's anything interesting that's come out, but not really one that I think is worth it. DPST, we talked about it. We're already in on that. STEM is one we talked about, I believe, a week ago on the live stream, and it looks like it's still on that list. STEM Inc., yeah, down another 8%. Gross. So, geez. This thing's been getting slammed. This 6th level looked really good previously. Go to the 3-year chart. Boom. You know what we're looking at right here. You see this price floor? This is a former SPAC. This is a former SPAC. We see this $10 price floor. So really not something that I think I want to get in on. They're not great, right? We looked at RMO earlier. 35 cents a piece. Disgusting. I don't want any piece of that. Just out of curiosity's sake, we could take a peek and see what's coming up next week. I mean, you could maybe get a 10-cent fill, 15-cent fill, and a 4.5, but that'd put you at 435, 440, which, you know, it's down there for sure, but are you going to want to follow this thing into the dark? For me, that's a no. ABR, I don't know anything about it. We've got 4 here that I don't really know a ton about, so let's kind of run through the exercise here to see if there's anything else interesting on here. So ABR, Arbor Realty Trust. Really, we go to the 1 year. A lot of these realty things are getting kind of slammed lately. Looks like it pays a dividend. This may be a situation where they announced that they're cutting the dividend, which is why it fell a ton. Because there was one, I believe it was Good, or was it Glad? It was Good. They announced that they're cutting their dividend, and overnight gapped down, and since have dropped another like 20-30%. I think Glad's actually fine. Yeah, Glad's better. But back to ABR, Arbor Realty Trust. Implied volatility getting up there, so a decent opportunity to potentially sell some puts. And what did we talk about last week, right? We talked a little bit about Dish and how when we see these surges in implied volatility, sometimes it's a decent idea maybe not to look right here, but to go a little further out. And Jeff in the YouTube chat saying, you know, REITs have been getting hammered. They absolutely have. And, you know, with this strategy, sometimes we do want to try and catch that falling knife, you know. We do want to be comfortable that, you know, Arbor Realty Trust or whatever REIT that you potentially look at investing in isn't going to, you know, go completely under in the next couple months. But if you could find a decent stock like this that pays a dividend, see what's going on here. We've got a price target of 12. This big dip started happening around 3.7. So let's see if there's anything on the news feed we could find here. Doesn't really look like it. Change in record date for the quarterly dividend. They had an offering, it looks like. They had an offering, so they diluted the stock a little bit. But look, you've got this surge in implied volatility. The thing's oversold. This is a situation setup-wise where I'd probably want to look, you know, 45 to 60 days out, and we've got these 61s for June. So what I would want to do, ooh, man, this is interesting. What you could do is get a little bit more aggressive, say, hey, we're going to sell the 10 strike, we're going to get a buck on it, we're going to wait 60 days, and we're going to get an 11.42% return. Because look, we're selling something that's 61 days out. I don't know why I can't hit the buttons I want to hit. We're selling something 61 days out. That's a little under 9 weeks. So if we have 8.7 weeks and we're able to get 11.42% on 8.7, that's 1.3% return per week, so long as this stays above 1032. Now, we never want to preclude the potential for this thing to rip all the way down to 9, but the idea potentially here is that if that does happen, you don't own a stock at $9 a share that's paying a 40-cent dividend. So is that the worst thing in the world? Tough to say, but all that we do know is looking backwards historically, there have been a few times that this thing's got a little bit oversold. We see one instance back here in June of 2022, and it popped back up very, very quickly. And again, in turn with that rebound is a decrease in implied volatility. But we see another example of that here in the end of September, early October 2022. Gets oversold, pops back up, and with that pop back up, implied volatility comes back down. So as implied volatility is coming upwards, and we're probably going to be able to visualize this. I really don't know what the premium looks, or what the volume is historically has looked like, but I imagine if we pull up the chart here, boom, what we're going to see is this thing has gone from the beginning of April, this was 65 cents a piece, and now it's up over a buck. So even if, one, it could just hold above 10 and we know we're going to hit max profit by June. Two, if the implied volatility starts to come back down on it a little bit, we could potentially come back down here at 8 or 6 and get out of the trade very, very quickly. I think the idea of selling some of these at 10 is very, very interesting, because the other thing, when you go this far out, it only takes 3,000 of buying power out of like 9,000 of max risk. Now, what you could do is maybe take a peek at the 7.5s. Now, this isn't quite going to be 1% ROR, but what we do know is that these further out of the money options in this 45 to 60 day window are going to decay a little bit more quickly. In fact, let me see if I can find this theta decay curve on my other monitor and bring it back over here. I'm giving myself 4 more seconds to find this thing. 3, 2, 1, boom, found it. So what we have here, if my computer will hurry up and put this on the screen, is 3 different types of theta decay curves. You'll see in the money, which is, just typically your normal gradual decrease into expiry. You'll see at the money, which speeds up a little bit in this 30-day window, which makes sense, right? At the money is going to really ramp up that exponential theta decay, is what you could see right there. But what's most interesting is out of the money. And this is what we would be looking at with this potential trade. And what you see is starting with the 60-day window here, and maybe a little bit outside of that into 75-ish, but kind of in that 65 to 70-day window, this starts to accelerate a little bit up until the 45-day period. We talk a little bit about that in one of our videos, but this is a trend that's very, very interesting to play. So we know that the further out of the money we go, the more we'll take advantage of a decay curve that looks a little bit like this. So what that would tell me is that instead of selling the 10s, which would probably be considered at the money with the closing price of 10.32 on Friday, what we could do is instead sell 10 of the 7.5 strike puts. One, we're getting ourselves a much better break-even price, right? We're going to have that break-even price sitting down there at 7.10, which is all the way down here, a fantastic place to be. And we probably get a little bit of buying power benefit as well, right? It only requires $1,300 of buying power. And if you want to be a return on capital type investor, that's making you $400 off. Oops, I hit multiply. My typing has been really good tonight. That's $400 off $1,300 in buying power, which is a 30.7% return on capital. Now, of course, we want to be a little bit more conservative. We want to avoid the clickbait. This is a 6% return on risk. So that's what we're going to talk about. That's what we're going to advertise. That's what we're looking at. Now, it's a 6.01% return in a little bit. It's like 8.5 weeks. So it's just under 1% ROR. But I really do like the idea of taking a bite out of these 7.5 strike puts and just letting them sit. And the great part about this is if the market moves back up, these are going to have the premium sucked out of them very, very quickly over the next 15 days as implied volatility comes down on this. And the price moves up. And, presumably, we hopefully maybe 2 or 3 weeks in would have the opportunity to close those out for 50% of max profit, meaning we'd get 20 cents, we'd get a 3% return in 2 or 3 weeks. So much more in line with the 1% per week. But that's the type of trade we want to target when we see oversold RSI and peaking implied volatility. Because, the idea is implied volatility does spike, but it normally comes back down, right? It's not going to stay up here on a realty trust forever. Now, it may be worth a little bit more research to be sure that there isn't some sort of issue. I think a lot of the issues here are, dilution, but it looks like just on March 20th, they announced a buyback program, which was this day right here. So it went up a little bit. It's fallen back a little bit since, but they have an active stock buyback program. It looks like at the end of the day, regardless, owning this thing at 710, as we see right here, is really not a bad place to be. And it just has to hold above this red line for 2 months for you to hit profit. And above this red line right here, which is basically on top of it at 7.5, for you to hit max profit. So I'm a big fan of potentially selling some of those 2 month out options. Much, much lower maintenance, lower buying power requirements, but still similar returns to what we like to target on a week-to-week basis. So I might make a little note to self about the ABR June 16th 7.5 strike puts. ABR June 7.5p, and we want to target like 0.4. We'll try 0.45. That's the great part. You know, there's a 5 cent wide spread, which is pretty tight. Not a, I mean, some volume, right? You got 191 on there. But the great part about this thing expires in 61 days. You could put a limit order out there and just let it sit forever, right? And if it fills, it fills. Someone might find your order. But back to the scan. We've got CTLT. CTLT Catalent. I really don't know much about this one. This is a massive red candle on a 1 year basis, 25.75. It's definitely gotten lower than that before. This looks very, very volatile on a 1 year basis. But this definitely looks like some sort of a news-driven dip. Yeah, this is not the old organic stock price decrease that you're used to seeing. So this is a drug manufacturer that dropped 25% after profit warning and the CFO left. So a couple things I don't like there is, one, profit warning, hate that. And two, it's a pharmaceutical drug company. They tend to be much more volatile. And like we mentioned a little bit earlier in the stream, that is the type of industry that lends itself to some massive, massive ups and downs. We could sell a lot of premium, and we could sell a lot of premium very quickly. But sometimes in specific industries like biopharma, like drug manufacturing, the amount of premium we sell can't really cover us from some of the severe moves that we see in that space. So let's go down to Max. Take a look at Max. What is Max? Media Alpha Com. This looks like a very low volume stock judging by these candles, but see what 3 year looks like. I mean, this thing's fallen down a ton. It looks like it's kind of trading near the base. We've got some potential support at the 9-ish level. We've got implied volatility coming up, but RSI is very, very low here. We've seen it get down into the blue decently a couple different times. The first was back, May of last year, where it got into the blue down at 10. Continued down into the high 8s, but then quickly was back above 10 within a month or two. So that gives me a little bit of bullish confidence in this one. We look at April, what we're going to see, widespread, not a ton of volume outside of that. And quite frankly, these are only monthly options, not really worth it for me. Let's look at HLF to round out the bullish potential trades on this scanner. Herbalife, this company, fun. So 1 year basis down to 29.17. Looks like, it's below what I would consider support at 15.35. So until it gets down maybe below 14 into this, under 13 range, I don't know how comfortable I am in that stock. This one's got weekly options at the very least, and they're only offering about 1% ROR. Now I say that, you'd be able to sell the 14 for 15 cents and get a 13.85 break even price. And on a 20-day basis, 13.85 looks pretty damn good. So, that doesn't look horrible. I just don't love the company. And of course, your recourse for all of these things is owning the shares. I just don't want to own the shares here. I don't like that level. I'm going to leave HLF alone. We don't see something similar to, similar to ABR, where we have this increasing implied volatility. So not for me on this one. So that's bullish. We got ourselves a decent opportunity here, I think, with ABR. We already have a lot of bullish trades lined up for next week, but we potentially want to balance those out a little bit with some bearish trades. And the reason we want to do that is because we want to try to make money and benefit off theta decay, regardless of what direction the market moves in. So we want to balance out the deltas a little bit, especially anytime. And I'm overall bullish on the market at a given point. But when RSI is above 60, which happens very, very rarely during the year, that's when I want to be balanced out. And not necessarily, I want to be all in bearish. No, that happens when we get into the red, which doesn't happen very often. But when we get into the red, that's when we start going all in bearish. but we want to be at least a little more balanced 60 plus. So let's try to find something we could potentially put on the other side here. If we go to intersect with, instead of oversold, we go to HT overbought and see what we could find. We'll try to do this quickly. We're getting to the top of the hour. We've got a few decent opportunities here. And yeah, I think let's go one by one. WW, this is going to be Weight Watchers, if I can type it in. This scares me a little bit. And with a lot of these, sometimes I think it's okay to sell naked calls and roll those. But with stocks like this, where you've already had it demonstrated like 100% gap upwards, this is not a place where it's okay to do that. And I think a credit spread's probably the best way to approach it. So on a 3-year basis, look, this thing can run up so much higher. Do I think it will run up that much higher? Absolutely not. This stock probably sucks. It's running up because I think they had some good, let's see, strategic acquisition. Goldman Sachs upgraded them. The thesis on Weight Watchers is absurd. Fund manager says why he'd short the stock. Okay. We've got a price target raised to $7 a share. It's already above 7. This looks like a pretty good bearish opportunity. Now, the idea here is let's go start big picture, zoom in smaller. We've got some potential resistance. I mean, literally right here at this level. And you'll see the tops of these candle wicks bounce right off of 8 pretty cleanly on Friday. So I kind of wish I had been staring at that one. But coming into the upcoming week, we've got some premium maybe at 8. But what's really tough here is you'd probably sell these 8-strike calls for 30 cents. And then you'd buy 9 behind it for 10 or 15. This is where the wide spread kind of hurts you a little bit. Because if you wanted to go 8 and 9 for $1 wide, you get 15 cents. But to me, even though that has a 8.15 break even, if this thing kept running, this thing so easily could get up to 8.15. And your downside on this trade is potentially losing $850, as we saw, if it goes up to 9 plus. So while I do think this is a good bearish opportunity, the way that I typically would play it via option selling just doesn't, I don't like the way that the numbers are working. And I mean, you could potentially get a little bit more aggressive by going right at the money with the 7.5 strike short call and then going 8.5 on the upside and saying, hey, let's get 250 and lose 750 at most. But even that is still just not that great. You know, you're almost taking something on 50-50 because you're going dead at the money, and you've got like a pretty skewed risk to reward there. Now, granted, this thing would have to jump up a bunch to get to that risk, but after the move we saw last week, it's definitely not out of the question. So maybe keep an eye on this one, and if IV really starts getting crazy, because IV is not getting crazy right now. The spikes that are easier to play down are when IV gets like this, like we saw back at the beginning of March for Weight Watchers. These are easier because it pumps premium into the options. This is a spike with not a huge corresponding spike in implied volatility. So it's a little tougher to play back down with short options. So probably leaving that one alone. Marathon and Riot. These are going to be one and the same, and I think we're going to pick one that we like better based off the charts. So Mara, boom, we're up here. It's at like 12 a share. Resistance looks like it's at 15-ish. Not in love with it. Riot, this is much, much better. Run up much harder, 325 to 1348, where Mara's gone from 311 to 1197. So Riot doesn't have a corresponding increase in implied volatility. Neither does Marathon. But Riot, just based off of how much it's run up, and what's a little tough is, you know, it's already kind of cooled off a hair. But let's keep going further back here. 1 year, 1521. Let's go a little further out. I know this thing got way, way high, but you know, 13-ish, 1350, right where I've got this line is about where this stock sits at. Doesn't seem like too bad of a point to play it back down. But now the big question is if we go to the single legs and look at what kind of premium we can get, I think now we're talking here. We've got some much, much larger numbers. One thing we can think about is, you know, this is 5 days till expiry. We could potentially go 2 weeks out to give ourselves a little bit more time to watch the trade, manage the trade, and more importantly, give it some time to cool off. But on a 1 year basis, this thing's at 76.94 RSI. What's Mara? Is it higher than 76.94? No, it's not. So that's what we've got there. This is much more overbought. I think the 14 level would be a decent level to play it back down from. The old high is at 1521 over here on a 1 year basis. Maybe going 14 and then long 16 wouldn't be the worst thing in the world. Let's see what a 14-16 spread would look like. So we've got here's a 38-cent credit. I probably would only rip about 5 of these. You'd make 200 bucks. You'd have risk of 810, but again, that risk of 810 is only up at 16. We bought something a little bit further out of the money here. Break even price would be 14.38. Let's play around with this a little bit. Let's see what happens if we go 15, 17. So that's 21, a little bit better. Let's see what happens if we go dead at the money. 1350, and then like 1550. That's 52. I think 14, 16, $2 wide is probably going to be the way to go on this one. Reason being is you save a little bit of cash by going at the wider spread, right? Because max profit here is like 190. If you wanted to go like here and get 140, you'd have to do 10 of them. That's more commission. And on spreads, it kind of matters because you got 2 legs on both sides on the entry and the exit. So definitely mindful of that part of it. But I think keeping it at 5, going 14, 16, 38 cents. It's not horrible. Risk reward may be a little bit off. But again, you've got a break even price. We go to the 5-day here. Your break even on this spread is going to be 14.38. And on the chart, that looks like this. So you're above last week's highs. Friday was a little bit red, which makes it tough from an entry perspective. But one thing that may be good to keep an eye on, and this is, I think, a good idea to potentially look into the following week as well. What does a 14-16 look like expiring April 28th? So if we go 14 here, we go 16 again, we're going to get an even better credit, 1, and we're going to get a little, oh, that's 10. We don't want 10. We just want 5. We're going to get a better credit, lower max loss, and more time. I don't hate the idea of that. And then potentially if it moves in our favor and we're able to close out for half of max profit, we're taking home 120 bucks. I think this is the winner right here. Going a little bit further out, just making it a couple week long position, but making it in such a way where once this thing falls back down, and I imagine it will, right? We go to the 1 year. Anytime this thing gets up this high, and it hasn't been this high in the past calendar year, but anytime it gets in the red at all, within a week or two, you know, this thing has either gone flat or fallen back down a little bit, and that's all that we need to either take profit or make money on the trade. Can we throw the risk analyzer quick on the spread? What do you mean by the risk analyzer? You mean looking at something like this where we show the risk profile? And we, how do I add that? Add simulated trade. You go here, vertical, bing bong, 14, 16, go down to 5, and then click over into risk profile. So there you go. So here's what you see, your break-even price. You see it again at 14.45. You go all the way over here. I mean, you're making cash, max profit anywhere under 14, obviously. That nebulous area between that max profit point and your break-even, you're getting some form of profit. And then, boom, your max profit's down there. Your risk is capped, and that's exactly the kind of thing we want. That capped risk. And the great part about these longer expiry spreads is if this thing really rips against us, you know, we're not going to have to take that max loss. We could close out, and I think the premium on it is going to be enough to where we could close out for under max loss, just call it an L, and just keep the train moving, right? So that's what we've got there. I like that idea. Let's go back over here. Let's talk a little bit about the Riot. It's going to be a 428 trade. April 28th, we're giving ourselves 2 weeks. That's going to be a 14.16C. And we're going to try to target about a 48-ish cent credit on that. So we've got a couple decent options, one bullish, one bearish. Let's finish out the list here. TSEM. I have no idea what this is. Tower Semiconductor. Interesting. This is coming back up on resistance. This is a 1 year chart. It doesn't look like it's getting too crazy. Implied volatility is still kind of even keel down there. But RSI is just absolutely through the roof on this one. Is there any recent news that has caused the big jump? It's a Chinese semiconductor. This is potentially a little scary. Is it a Chinese semiconductor? There's an article about China's tech weapon. Let's go to the analyze. It's going to tell me exactly where it is if I go to fundamentals. TSEM. Doesn't tell me anything at all. So let me look off screen really quickly. Tower Semiconductor, it is Israeli, so it's headquartered in Israel. So I'm not in love with foreign companies because I think there's a little bit of additional risk that you take on with some of those. But semiconductors as a whole, TSEM, I mean, NVIDIA as well, these things are all insanely overbought. AMD's cooking again too, but not nearly as bad as this one. But we get back to TSM, something similar. We're running back into 46. Is there premium on 46 that we could find on a single leg? The answer, no. There's no volume. There's nothing going on here. One thing we may want to look at for these semiconductors is, I believe it's SOXL. I believe that's a semiconductor ETF. And if this comes back down, we're going to be looking good. Now, I don't know if there's a lot more room for semiconductors to run. So I wouldn't hate starting a bearish position with the break even in like the mid 16s. So we look at this, and that's exactly what we could find. We could sell a 16 strike call. We could sell like 5 of them, again, starting off half sized. It's going to take a lot of buying power, that's for sure. But, 215 profit, you start with a 1643 break even price. And this isn't the type of thing that I think is going to just sprint against you in the other direction. Now, of course, those are famous last words. And on a 1-year basis, RSI is only down to 47. With these leveraged ETFs, I would much prefer to, give me 1 second. Yeah, it's a semiconductor 3x bull shares. Anything triple leveraged, I really would prefer to wait until, RSI goes one way or the other. And at 47, it's just not great. I like the idea, but I'm not in love with the idea. And, history has taught me to stay away from those types of trades. Keeping it moving, STNE, I believe this is healthcare related, StoneCo. I could be completely making that up. But if I'm not making that, or if I am making that up, this chart looks phenomenal from a bearish perspective. We're hitting multiple tops right here at this like 12-ish level. RSI is through the roof. Implied volatility is down decently. But if we go to fundamentals, STNE, looking at StoneCo, and it is a provider of financial technology and software. Interesting. So if we were to sell something around the 12 strike, and let's check, yeah, they've got weekly options. If we were to sell some around the 12 strike for 30 cents, this doesn't look like a bad trade to me whatsoever. You get that 12.30 break even price, 150 a profit. You start a bearish position at 12.30, which is almost dead on where this red line is, and you've got something that hasn't traded above 1263 in a calendar year. And that's not to say that it can't trade above 1263, but with an RSI of 75.74, this is a decent time to step in the way of this one. I think it'd take a lot to get it up and over that hump. Let's just check the 3-year chart to make sure nothing crazy's happened. That's a lot, but it's not listed as hard to borrow. If you're really worried about that kind of thing, you could turn it into a 12-13 spread and get these 13 strike calls for probably dirt cheap, which might be a smart way to do it, to be honest with you, because everything isn't dangerous until it is dangerous. And you could take that variable out of the equation by paying a couple cents for these. And instead of having a 30 strike credit, you have like a 28 strike credit, and you don't have to worry about it ripping up and ruining your financial future. So STNE, let's call it 12, 13 strike calls on that one. And since we reduce risk, we could maybe open a little more. 13C, and we'll target like maybe a 28-cent credit on those, right? We want a 30-cent credit here, and then we'll probably pay 2 cents, 3 cents for one of these to hedge that position out. So I like that. RGLD, let's see what we're working with RGLD. RGLD, Royal Gold. This is interesting. Yeah, metals are getting very overbought. I mean, this is almost textbook right here, going back up to this 147 level. But it's run very hard, very quickly. We go to the 1-year chart. Boom, 72.37. It looks like it kind of already peaked a little bit. I don't want to be catching this on the downswing. Another metal that I do know that is overbought is if I get a SLV. Silver, that's annoying. I didn't look at this on Friday. I tried to short it on Thursday, and it looks like we already got the move. So never mind. Forget that I said anything. But again, more proof and more support that when RSI gets crazy, and this got above 80, which is like, in my opinion, can't miss overbought RSI if you have it on just a normal run up like this. It got up above 80 and it took a pretty significant gap back down. Back at that 23, 24-ish level, not a ton of premium. I'm going to ignore that one for now. Last one, Lululemon, which is running up a little bit. And I know some people in the group, maybe some of you watching right now, have got some short positions on this one. To me, this is a little bit tougher, right? We see with some of the other ones that we want to play down, like STNE, it's a gradual run up. Now, that gradual run up does have a lot of large green candles included in it. But when you look at Lululemon, it's the result of earnings where they gap up. So really, this overbought RSI that you're looking at isn't necessarily the result of a run up like something like this where you'd expect it to come back down, but rather it's more the result of this individual candle right here. And since then, it's been pretty flat. So just because RSI is high here doesn't necessarily mean that it's one that I would potentially want to step in the way of. And especially if we look at the premium on the call options, there isn't a ton, right? You look right at the money, it's 1% ROR. That's not a lot for something that's moved the way that Lululemon has. So not one that I would recommend trying to get in the way of, especially with that $368 price tag. If you wanted to sell these non-spreads, sell a naked call, it takes so much collateral and could just crush you on something that, isn't that great. If it gets back up to this 386 level and keeps pushing with this high RSI, I think then you potentially have a case to play it back down. But the way it sits, I don't really know about that. But that's about all we've got, right? We ran through the overbought. We ran through the oversold. Earnings are coming up. We don't have enough time to talk about that, but I'm sure we will discuss those into oblivion in the Discord server this week. And if you want to join that, hourglass-trader.com, big purple button in the middle, join our Discord server. So we've got all these positions lined up. These are all bullish positions with a couple hedges on SPXU and DWAC. We found another little long-term position with ABR that I think could provide some fruit for us. And a couple bearish positions that I would like to open in the meantime to potentially try to grab, another, what do we call it? 400, 500 bucks-ish over the next week or two, just in case the market decides to go in the opposite direction and hedge us out a little bit that way. But with that said, that's all we've got. We have made it successfully to the end of another one. I watched one of these back the other day, and I could not believe how much I was saying before every individual word. So just know that in the back of my head as I'm speaking on these, I'm trying not to do that. And I almost did it right there again. It's kind of difficult, but hopefully I will get out of that habit and get into better speaking habits for the streams. But that's all we've got for this week. Oh, I almost did it again. That was so close. Thanks. I did it. All right. Thanks to all of you who have tuned in, not just tonight, but every single week so far. I appreciate those of you checking in the chat, supporting and watching our Twitch streams, YouTube streams, whatever medium you're watching it on. Even if you've made it to the end and you're watching the replay, appreciate all of you equally. Those of you active in the Discord server, always happy to see it. We can all continue to make money together. It's been a great year so far, and I think we can continue to build on what we've got. But that's all we have. Until next time, this has been Hourglass Trader, where as time passes, we make money, and hopefully we will see you guys again same time next week with more money in our account than we have right now. Hopefully $1,469 more dollars in our account than we have right now if our plan goes exactly as we anticipate. But to avoid rambling at the back end of a Sunday night, that's all we got. I'm signing off, and we will see you hopefully this week chatting live in the Discord server.